Hi, this is James Shug with Westpac London's end of day report for Monday, July the 30th. Look, it was another decent rally in European markets today. Heading into the European close, the markets are all up higher. I'll give you some numbers actually straight up front. The FTSE up 1.2%, the French market up 1.25% today, the Germans up a similar amount. The Spanish market and the Italian market both up almost 3% at the close, but the US market's struggling at the moment, so there's two different sort of stories at play. Firstly, in Europe, there's still this sense that something is going to happen at the European Central Bank's policy meeting on Thursday. There are reports that the ECB chief, Mario Draghi, was having meetings with the Bundesbank boss, Weidmann. He's known to be against the ECB buying bonds of sovereigns like Spain and Italy. So maybe he was trying to persuade him to change his stance there. Apparently the US Treasury Secretary also has had Mario Draghi talking to him, maybe trying to get advice on how to deal with political leaders that can't make decisions except when they make the wrong ones. That's an issue that Draghi's had to contend with in Europe, and of course Geithner has got the same problem in the US Congress. So whatever, it's this sense that something's going to happen this week that's going to bring down bond yields in Spain and Italy. That has already meant that those yields have fallen quite sharply. For example, the Spanish 10-year bond yield today is 6.5%. It was at 7.6% on sort of Wednesday last week. So there's a lot of expectation already priced in. And as I said, markets have posted yet another decent gain today. That's despite some disappointing news. I mean, the latest round of European business surveys was very weak. The Business Climate Index fell to its lowest level in this cycle, and it's also now at the level it was running in October 2008. That's 6 weeks after the Lehman Brothers collapse. Similarly, the Economic Confidence Index put out by the European Commission is also running at post-September 2008 levels now. So basically, these surveys are already pricing in something calamitous happening. Now, the cut-off point for these surveys, I think, wouldn't have incorporated the last few days of optimism, but if there's any bounce in the August surveys, it's only going to be if something pretty decent is announced pretty soon by the ECB. Or maybe not announced, but nevertheless done, and then gradually markets would cotton onto that, and the recent rally would be then justified if the action was deemed sufficient. In the UK, we had a whole bunch of data out on housing and credit and retail, all of it weak. A lot of it was related to the public holiday issue in June, but there does seem to be some underlying weakness in figures related to retailing, related to mortgages, related to consumer credit. So that's a bit more of a sort of support for the weaker GDP numbers that we saw of late, in contrast to the still relatively strong jobs growth that we're seeing in other reports. Of course, the Bank of England has its policy meeting on Thursday this week too, although they've already extended their quantitative easing program. Nowhere near as much trouble doing it in the UK as Draghi seems to be having in the Euroland, in the Eurozone. Now, coming on to the US, I mean, the Dow in the US at the moment is down 0.15%, so whereas there are 1 to 3% gains in Europe, the Dow is struggling. The Dow was in positive territory earlier on, but the mid-afternoon London time release of the Dallas Fed factory survey was very weak. And that backs up the message from the Richmond Fed survey, the Philadelphia Fed survey, but not the New York Fed survey, which fell in June but then bounced back a bit in July. But the majority of those Fed surveys are looking weak, and that suggests that the National ISM factory survey, which comes out on the 1st, which is Wednesday, could also be weak. So it's undermined stock markets. Now, of course, weak data sometimes benefits stock markets if it means that there's a better chance of the Fed embarking on another round of quantitative easing. But I think markets have shifted off that a bit, at least for this week's Fed meeting, because the GDP data late last week weren't perhaps weak enough to kick the Fed over the line as soon as this month. That's about it, I think. Oh, yeah, German banks, should mention, had a bad run lately, but one report today showed that their cross-border lending has been pulled right back, and so that saw banks like Deutsche and others marked a bit higher. That helped the German market today. I think that's about it for markets in the equity sphere. In commodity markets, we've got the oil price down 0.3% today at $89.87 a barrel. Modest fall, 0.2% fall in copper prices, and gold's pretty much unchanged at $1,623 an ounce. And the Aussie dollar's at 1.049 against the US dollar. So it's just under $1.05 now. In Australia today, Tuesday, we've got building approvals. They surged the previous month because of blocks of flats. I think it was in Western Australia. There's going to be a big negative, almost certainly, in this month's building approvals figure for June. But look at the underlying story for houses, and you'll get a better feel for the story there. Our sense is that there's going to be a bit of a hole in activity in the middle of the year, but a bit of a pickup in housing as lower interest rates start to bite later this year. And we also get the Reserve Bank credit figures as well, personal, business, mortgage credit data. Okay, that's it for today. Back tomorrow.